Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week, guys, we're going to talk about FOMO, bad trades, and failed traders. You heard me, FOMO, bad trades, and failed traders. Do you kind of fit that category a little bit? Well, if not, good. If you do, then you definitely want to continue to watch this video because we're going to talk about a lot of things or reasons why people struggle as a trader. FOMO, fear of missing out, is definitely one of them. You might see a really good pattern. Perhaps you just missed that really good pattern, and then what do? You take a crappier pattern on the same stock that doesn't work, and then you're really frustrated by it, okay? A lot of traders out there, just because of lack of knowledge, lack of education, lack of understanding, they take just bad trades, right? They don't understand what a good pattern looks like. And then when we look at failed traders, there's a lot of reasons that they're failed traders. Most importantly, and I think most common, is they don't take stop losses. They don't have good trade management. They have terrible money management. Their expectations are just not in alignment with reality. This is a very tough business. Probably the hardest thing you'll ever do in your entire life. Outside of being in the military, it probably is the hardest thing anyone could try. One of, certainly anyway. And a lot of people are coming in with these expectations that in 2, 3, 4, 6 months, they're going to be a rock star. They're going to be Michael Jordan, but you're not going to be. It's going to take you 2 or 3 years probably. So we're going to talk about the path to success, how to stay out of bad trades today, how to not give into the FOMO that many of you guys have. So it's a very important lecture because it's going to help you succeed as a trader, not fail as a trader. Too many of you are reading these headlines out there that you can get rich quick and this and that, and if you just take this one perfect pattern, or hey, I can make you 5,000% in 10 days, just give me your credit card number, these binary options and crypto guys and stuff. Guys, this is a tough business. You're going to work for it, and you're going to earn every single penny that you make. So today's lecture is going to show you how to do that, how to stay on the straight and narrow, how to stay out of trouble, and how to resist some of the FOMO that you're experiencing as a trader, and how not to compare yourself to other people, especially when you're new. All right, so if you like these videos, please click that like button, hammer that subscribe button. I'd really appreciate it. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is FOMO, bad trades and failed traders. And you're all looking at this going, that's me, and that's me, right? And the goal is for you to not be any of those three things. You don't want to have fear of missing out. You don't want to take bad trades, and you certainly don't want to be a failed trader. So the question is, why are you? And I'm not saying failed traders and, oh my gosh, you're blowing up a trading account. That's not what I mean. I think the vast majority, I think this business gets a bad rap because everybody thinks a failed trader is someone who blows up a trading account. There's a lot of people that quit just through attrition, right? It's like, hey, I need to pay my bills and I'm breaking even, or I'm only making a few $100 a month, and they end up quitting. And that's a person who likely could have gotten it but didn't give themselves enough time. So we're going to talk about that. We're going to talk about people that do take bad trades because they happen every single day in the chat room, and I wish I would have thought of this topic sooner because I could have spent a week in the chat room just literally pulling out bad trades that people mentioned, because about 50 to 100 of them happen every single day. All right, I only pulled out 2 or 3. I wish I would have pulled out more. And then FOMO, fear of missing out, and we're going to talk a little bit about that because of a trade that I took yesterday. So I'm going to include myself in this a little bit, especially on the FOMO part. And the key, guys, is we understand we're not perfect, right? At least most of us understand that. So the question is, how do we make money being imperfect? Well, we're going to talk about that today, okay? Because it can be done, because it has to be done, because no one is perfect, all right? So keep that in mind. But before we do any of those things, let's talk about when will the insanity stop. This week's is a good one. It's a very good one, but it's a sad one. And I know I frequently say this, like, hey, I do this as a wake-up call, but I really mean it, guys. I'm doing this as a wake-up call. Like, if I could sit next to you and just slap you on the side of your head with some of the stuff you do, I would. This is, I shake my head over. I don't even know what to say. Somebody sent this to me about a week ago, and it is burned my account fully depressed. I had an initial investment of $37,000. I took that up to $52,000, okay? And look at the top. January, February. So in 2 months, a brand new trader made $15,000. Brand new, okay? And then when we had the pullback in late February, things started to go sideways with me. Took a major loss. Then my emotions got the best of me. I traded with oversized. Think about what I just said here, guys. Really, I want you to process this. Somebody who turned 37 into $52,000, who made 15 grand in 2 months as a brand new trader, is now saying, I then traded with oversized, with too many shares. Well, what the heck were you trading with when you started? About 100 times bigger shares than you should have traded. Now what are you actually doing? Holy smokes. Right? Weak risk management, I'd say very weak. I went heavy in trades and most of them ended up with a big L. Tried to make up for my previous losses, FOMO, right? One after another until my account is now at $2,600. Crazy. I can't express how I really feel. It's beyond me. Now I spend all my day thinking about what the F I did, depressed and feel heavy pressure that I don't know how to get back up. Zero confidence. That's a real person. You can clearly tell by how it was written that that's not probably a joke to this person, that they're really feeling this way. It's really gotten me mentally. I'm 22. Well, here's the positive. You're 22. Here's the negative. You're 22. Right? The negative is $37,000 invested at 22 years old. If you were to just let that ride in the market at 8 or 9% for the next 30 years, you'd have a significant amount of money. You'd have more money than 90% of Americans that retire. So that's the negative. The positive is you're 22 and there's plenty of time for you to get it back. Okay? But I'm telling you this because this is really serious stuff. I know every week. Sometimes I almost think we've gotten to the point where when will the insanity? We just overlook it now. It's like the first 10 or 20 that we did were like, whoa, whoa, whoa. Now it's like, yeah, every week, Jared, you do this. So what? I do it to remind you guys that this is no joke, and it's so easy to burn through money, and it's so much harder to get that money back. So what's the answer here? Don't do it. Just don't do it. Okay? If it sounds too good to be true, then it is too good to be true. Okay? If you think you're going to make, 100, 200% per year and you're brand new, you got another thing coming. Check your common sense. Okay? So anyway, this is a sad story for a 22-year-old. I don't know where they got the 37 grand because that's a lot of money for a 22-year-old. I didn't have 37 grand at 22. But the point simply is I feel bad for this person. Hopefully they learned their lesson, and hopefully they'll do it right the second time around. If they do it a second time around. Okay? All right, let's move on. You guys remember this discussion? I'll show you in a second. All right, so, to think real quick on that $37,000, it takes years for most people to save that kind of money. For most people, right? So, if you guys remember this discussion, I believe it was a week or two ago. All right, multiple time frames. Okay, when all time frames are in alignment, trading odds increase, but this rarely occurs. The big thing we took from this slide was you have to decide on your long-term bias and then your short-term entry, right? So we have two kind of time frames we look at. A bias time frame, which is like a 60-minute or a daily if you're an intraday trader. And then we have an entry time frame, which is usually a 1 minute, 2 minute, 5 minute, maybe a 15-minute if you're an intraday trader, okay? So those are two things that we do. And then we look at supply, demand, bar by bar, all that kind of stuff. And when we put those together, we should be able to come up with an acceptable trade, right? Between the long-term bias and the short-term entry, okay? And we did this. We looked at this chart, all right? I'm not going to spend much time on it because, well, we already did. And this is a 15-minute chart, a 5-minute chart, a 2-minute chart. And we're basically looking at the same thing, right? We're kind of piecing this together, so to speak. And the 15-minute, not so good. The 5-minute looks pretty good. And then inside the 5, there was a 2-minute buy setup. This is what multiple time frames look like. Again, I am not spending time on this, okay? This was an example of what you should be doing, the right things to do. You guys remember this too? Remember this discussion as well? You're like, I don't know, Jared, you haven't told us about it yet. Retracement levels, we talked about those. Again, I don't know if this was last week and the other one was 2 weeks ago, but the point simply is over the last several weeks, 2 or 3 weeks, we've talked about both of these. We did full lectures on these topics, okay? Levels are used to measure the strength and weakness of the move. They help us determine if the current trend will continue or likely reverse. The level of retracement helps us determine this. It also helps us determine the odds or success of failure, right? In short, retracement levels help keep our expectations in check. They keep us objective. And then we went on to talk about, don't worry, we're going to get to the good stuff in just a second. We went on to talk about 50% retracements, 100% retracements, 25% retracements, right? And we talked about supply increasing and why, for example, if we get to a 75 or 100% retracement, why that's a problem. Well, because we have to question the strength of the stock, because why is it taking so long for buyers to step up? It's like a pair of jeans that they have to keep discounting and discounting till finally somebody buys those jeans. You get to a point where somebody's like, wow, it's such a good deal, I can't refuse, right? Or it's so cheap, I don't care if I lose at this point. So we talked about these two topics over the last couple of weeks, okay? Guess what? Wait for it. The punchline. They mean nothing. Absolutely, utterly, completely, and totally nothing. Guys, if Unwall's saying the stock is thin, it's thin, okay? They mean nothing if you don't have discipline, okay? If you don't have the discipline to follow the rules that we just talked about, not taking a trade on an 80% retracement, if you don't have the discipline to look at multiple time frame analysis, then none of it matters. None of it matters. Okay, and this is an area I think that most traders are really, really struggling with. So I wanted to talk about this, not super long today. It's going to probably be a slightly shorter lecture, but I think it's a very powerful one in that most people fail for the same reasons, and they're simple reasons. They have no money management rules, or they don't follow them. They let one or two bad trades, one or two bad days destroy an entire month. They don't use or take stop losses. They bag hold, usually due to ego, the need to be right, etc. And I'm going to talk a little bit about this with myself today on this. I'm going to show you an example of a trade I recently took that I had to be right. I just had to be right here. And it ended up costing me more money than it should have. So we'll talk about that as well. They take bad trades due to several issues. FOMO, right? Fear of missing out. The lack of knowledge. They just don't have the education and just don't know any better. They lack discipline. So they have the knowledge, but they just can't help themselves. They're marrying their bias, which I kind of did a little bit on the trade I'm going to talk about. And then they have expectations that just have no basis in reality, right? No common sense. They want to get rich quick. They think the business is easy. And you just saw from the when will the insanity stop that this business isn't easy. And most people do want to get rich quick. Despite what their words say, their actions suggest something else. So I want you to keep that in mind. Your words mean one thing, but your actions are all that really matter. Right? You can say anything you want, but what you do is how you'll be judged, right? What you do is how you'll be judged, okay? So let's take a look at this first one here, this first chart, so to speak, okay? You guys remember this? It was yesterday, so you should, okay? Let's have a little discussion about this chart, okay? We talked about the amazing, incredible, great relative strength that Apple displayed yesterday. And it did. It's an undeniable fact that Apple had incredible relative strength compared to the market. The Qs here on the 2-minute chart, Apple on the 2-minute chart, you can see Apple initially pulled back for the first, 5-6 minutes of the day. It had a 3-bar play that failed, a failed 3-bar play, right? The market straight down. Apple straight up. After the failed 3-bar play, notice it peekabooed in and then ripped higher and failed. And then the market just kept going lower. Okay, so if you take a look right here, right around, 9:55-ish, give or take, that we had a little turnaround bar, a little engulfing bar, whatever you want to call it. And it happened twice, not just once, but twice, right? So you have a red bar with a topping tail, and you think to yourself, that's the high of the day. This might pivot, and this might be a sell setup. And then it gets engulfed by a green bar. Another red bar tries to push it lower, and another green bar engulfs it. And we're sitting here, while this is happening, the market is still going lower. Okay, and Apple is just going, I'm going higher. Then the market starts to, pivot a little here and try to push up. Apple breaks out. Note the same time. See this gray dotted line is 10 a.m. right there, that little doji bar is. Apple, right there. Apple's already moved 3 bars higher. And I said to you guys, man, this looks really good over 144 for a scalp. We're not going to marry this thing. The market's too weak to marry it, but Apple is showing incredible strength. And if the market bounces, Apple's probably going to be a good play. But we talked about it, a scalp up to maybe 145. For me, I was looking for about 1R, which in this case would have been 50 cents because the entry would have been 144 by 143.50, and I would have been out at 144.50. It went to like 144.75. Okay, so great pattern, great relative strength. Okay, great relative strength, decent pattern, a little turnaround bar, reasonable stop loss. So those are the positive attributes of this trade, okay? And this is a bit of a lie when it says missed ideal entry. It should say chickened out of ideal entry because that's really what happened. I chickened out, okay? Negatives, extreme market weakness, not a good thing. No support below in terms of the market weakness, right? There was nothing. The market didn't have support till $360. So we could have fallen a long ways. And I missed the best entry, right? Because ultimately I took lower high, lower high, lower high. And we took a 2-minute buy setup here. Now, had the market not put in a wide range red bar, perhaps, maybe this would have worked, right? Maybe, okay? So the point simply is the market was weak and really wasn't showing any serious signs of bouncing. Yeah, it had a 1-bar bounce, but there was nothing there to suggest that the market wouldn't pivot and go lower, right? Where it was at on the chart, the volume it had, how many days up or down the market was. It really suggested lower prices yesterday, if we're being objective about it. So Apple had to be a bit of a scalp, and I missed the ideal entry, so I bought the pullback. Now, was the pullback in a good spot? It was. It was sitting on some support here, some minor price support, level 2 price support, right? The entry, stop loss was fine. It's 45-cent stop. We could have gone back to the high of the day and got about 1-to-1. That was the goal. Okay, that was the goal. So the brass tacks is I took a partial lot. That's good. Why? Because there were question marks about the trade. Mid-trade, lowered stop, all right? That's not good, right? Lost $400 instead of 125. Now, let me explain here, okay? I got in this at 144.10 and I added at 144.20, okay? So my cost average was actually 144.10. So I only had a 35-cent stop on this thing. The stop loss was down here. It's actually technically right below this little green doji bar. This went down to 143.78, if you guys recall. When it bounced back up, what did I do? Do you guys remember? Anybody remember? When it bounced, it didn't stop us out. I had my stop and it held our stop by 3 cents. Literally went to 143.78, held our stop loss. Bounced back up. Does anybody remember? I did the cardinal sin that no trader should ever do. Now, there's positive and negative here. The positive is I had a partial lot. So in terms of money management, I didn't break my rules in terms of money. Like I was never going to lose more than that's the good news. The bad news is I did what you guys did, what you guys just said. Sorry. I lowered my stop. You never, ever, ever should lower your stop loss. All right. If you get into a trade, objectively get into it. And let's be fair, we objectively got into this and we gave it more room. The stop loss should have been 144. We should have really taken Apple with a 20-cent stop loss. I actually gave it an extra 25 cents for wiggle room. Double the stop, basically. So if it takes out double the stop, you don't want to be in it. Now, again, the good news is money management-wise, it didn't really cost me that much money. It cost me $400 with a $1,000 risk. So I still only lost 0.4 of an R. But I should have only lost $125 here. Okay? I should have only lost 120. I should have taken the stop. But what happened? Tell me what happened. I'll give you a hint. We talked about it on the last slide. What did I do? What did I do? Other than lower my stop, which is wrong. But why? Why did I lower the stop? What was the reason? Talk to me. What was the reason? I married my bias because I needed to be right. I did two things here. We'll go back to the previous slide. My ego got in the way and I just had to be right on this thing. I just didn't want to be wrong on it. And because I didn't want to be wrong, I married my bias. My bias on Apple was long. Now, initially, that was the right bias. And it looked like it was going to go higher. And that's fine. It's okay. What's wrong here is moving your stop loss. It's okay if you want to take a slightly aggressive trade, even though you should try to limit how many aggressive trades you take, obviously. But the problem here is we took an entry, we had a stop, we had a target. Fine. So far, so good. Entry, stop, target. The second you move your stop loss lower to lose more money, your head's being messed with when that happens. Somebody's messing with you. And it's usually your ego. Okay? So I just needed to be right on this thing. And I married my bias long. I said, well, yeah, I get it. The market's weak. We talked about it. Man, Apple has such incredible strength. It's amazing. And then a wide range red bar came in and Apple still held up a little bit. It did. It still held up a little bit. And then it kept going lower in the market. And Apple finally just threw in the towel and said, you know what? No mas. I'm done. Okay? So the point is I put a ring on it. And I should have walked away. Apple was a one-night stand trade. This was not a marriage trade. I should have walked away. And I didn't. okay? And now we're paying for the divorce, right? I'm not joking about it. I'm paying for the divorce. I should have walked away before I put the ring on it, and I wouldn't have to worry about the divorce. Now, because I married it, I'm riding this bad boy into the depths of hell. And instead of losing 125, I lost 400. Now, the positive, I didn't lose 1,000. That was a full R. That's good. But I should not lost the 400. This is an analogy, guys, for bigger stuff. See, you're looking at it going, well, geez, Jared, $275 extra is not a big deal. You're right. It's not the point, though. The point is, when you do this, it costs you money. And the more often you do this, the more expensive it gets. And then all of a sudden, you sit on a stock and you're like, yeah, I think I'll just hold it tomorrow to see if I can get back to break even. Think about what I'm talking about right now, okay? Think about it. You take the stock that you should have been out of, and magically, for some strange, crazy, stupid reason, you're holding it overnight. You're going, well, the market got crushed. Of course it's going to gap up tomorrow. What if it doesn't? Now that 400 becomes 1,000 and then 4,000. And those types of things are how this crap happens. This garbage, this stuff. When somebody takes 37 into 26, it's technically 52,000 into 2,600. Right? Think about that for a second. All right? So you look at this. All right? What I actually did, Braden, is I had 700 shares left of Apple. I got rid of 500 of those shares, and I held 200 overnight. And then today I did get out of it at even. But that's not the point. The point is, what if you hold all of your shares and it goes against you, and then the next day gaps down and goes against you, and then against you, and then against you, and then against you. And all of a sudden you're bag holding now, and you've just destroyed your trading career, and you're only a month into it, or even a year into it. It literally only takes one trade. And I want to be clear, it might not blow up your account, but it might eat up your buying power. It might cost you 5, 10, 20, 30 R for no reason. None whatsoever. You could have just taken the loss, checked your ego at the door, and moved on. It's an expensive habit. So the point is, don't make it one. Make it a one-off mistake, a two-off mistake. Because if you bag hold even once, wow, the damage it could do to your account is permanent, potentially, right? It's permanent. So that's number one. That was just bad trading. Was the trade itself terrible? No, it wasn't a terrible trade. We took a scalp idea with a partial lot and a stop loss. So far, we're good. It's the second you decide, you know what? I believe in this so much, I'm going to lower my stop. No, take the loss. If it comes back to your entry, get back in 84%. That's it. Move on. If you lose, oh, well, I lost. I lost $125. No big thing. Don't do this, guys. Just don't do it. Don't do it. That's it. That's all I can tell you. Don't do it. All right? Now, here's another example of marrying your bias. This was yesterday also. Okay? Private message conversation. I didn't want to make this public because sometimes conversations they go downhill. All right? Trader. Jared, what do you think of Tesla over 780? I think it's very aggressive in this environment, but Tesla's a beast. I still think it's tough. Okay? I have a stop loss 776. Okay. That's my way of saying, look, you're probably going to do this anyway. Like, what I say right now is clearly not registering. Fine. And as I tell you guys all the time, and I truly do mean this, I'm not being sarcastic or rude or mean anything. If you have a stop loss, and assuming that stop loss is never more than 1R, go for it. Like, I don't necessarily agree with the trade, but as long as you're not going to lose more than 1R, and you're not going to go below your max loss for the day, go for it. Take a shot at it. Do I agree? No, I think it's a bad trade. But fine, okay? And then it goes, this is the part where the conversation just turns really sour, really fast, okay? So far, we're disagreeing, but we're okay. We're okay. It doesn't really matter anyway because I'll just hold it if it goes lower and keep it as a swing trade. Oh, no. And then oh boy, that's pretty dangerous. Yeah, but it's Tesla. This stuff really happens, okay? Really, it happens. All right. I would like to take a screenshot of the actual conversation and put it in here. But People do this. This is called marrying your bias. Tesla was up 1, 2, 3, 4, 5, 6 days in a row. 6. Right? 6. And you want to take a double bottom in the world's weakest market. I mean, how weak was the market yesterday? Crazy weak. It was the weakest day we've seen in many months. That's how weak it was yesterday. What were we down? 2 or 3%? Something like that. It was pretty bad. And you want to go long on a double bottom retest below the moving average, below the trend line, on a stock that's not even near the high of the day, on a stock that's also up 6 days in a row. There's just no reason to take this trade. And again, if you want to take it and you lose an R, fine. You're going to take some bad trades. This would be one of them. I don't know what this person did with it. I don't know if they held it or got out. I do know it stopped out because it went below their stop right here and it went below their stop right here. Okay? Now, are they walking out today going, "Oh, I told you so, Jared. Ha, 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 ha." Maybe. Maybe they are. Right? Maybe they're like, "Ha ha, got you, Jared. It went to 795 today or whatever it went to, and I got my money out of it." Maybe. What if it didn't, though? And then, but it's Tesla. Those 3 words you should never speak in your life. But it's whatever the stock symbol is. We've had this conversation before. Most of the time you'll get away with it. Like 90% you will get away with it. At some point it will probably come back up and you'll get out of it. And in a bull market like we're in now, most of the time, yeah, you'll get away with it. But what if it's the 10% of the time you don't get away with it? It's account destroying stuff. It'll take your account for a roller coaster ride that you don't want to be on. And then what generally happens? Usually at some point the pain becomes so bad, so great, so nasty, you'll actually get out. And you'll take that 40% loss, 50% loss, 30% loss. That's what will typically happen. If the money is so crazy big, you might actually hold it into the ground. But if you had a 50K account and all of a sudden it pulls back to 40K, you might finally say, "It's affecting my day trading. I need to get out of this stock and make my money back." And this is what happens. That's that mental frame of mind. You don't ever want to be in that position. Ever. And what do you think saying to yourself? "Gosh, if I had just gotten out, I could have taken my loss and moved on. Shoulda, woulda, coulda." And now you've married it, right? You've married your one night stand and you don't want to do that. Okay? Let's take a look at another example. This I consider a lack of knowledge. All right. Yeah, it's true. How's GE doing? How's AIG doing? How's Citigroup doing with those reverse splits? Right? Never a good thing. All right. UNFI. This also happened yesterday. 45.10 by 44.55. Few people asked me about this. I got 2 private messages over this and about 3 comments in the chat log on this one yesterday. I don't know. UNFI was on our long list yesterday, which obviously it should have been because look at it. All right. And these were kind of the 2 areas that people talked about. This 44.50 area on the first red bar here and then the second red bar right here. I mean, this thing ripped off the open, right? I mean, absolutely ripped. It went from like $39.50 to $45. That's a pretty massive move. Okay. I'm telling you guys flat, and I made this comment yesterday, but I think it needs to be dug in a little deeper. Shorting crazy strong stocks is very challenging to do. It's much easier to buy the bottom of a retest or buy the bottom of a climactic stock than it is to short the top of a climactic stock. I'll repeat myself. It's much easier to buy the bottom of a climactic stock than it is to short the top. Okay? When there's this kind of institutional money and institutional interest in a stock, I mean, I don't know what the average volume on UNFI is, but I bet you it's not anywhere close to 9 million shares. I bet you it's less than 1 million. I don't know, but I'm guessing it's probably less than 1 million. Okay? This thing ripped. Shorted here, boom, quickly stop out. Shorting strong stocks, especially ones showing insane relative strength with huge volume, is very challenging. I find it's easier to buy a retest than short an extended move up, especially in a 10-year bull market. What's another example of this? MU today. Somebody asked about, whether they did it, I don't know, but they asked about shorting MU today. I said, you don't want to short that stock. It's been super strong. Yes, it was on our gap down list, but we had to change our bias on it because it told us to change our bias on it. I didn't tell MU to do that. MU did it for us. Remember we did a lecture a few months ago about let the chart be your guide. Let the chart speak to you. Don't speak to it. Don't talk back to the chart. Just listen. Right? You know, when your parents say you have 2 ears and 1 mouth for a reason, let the chart speak to you. Let it talk to you, and you just take in the information. You don't talk to it. MU told us today, I'm a long play, or I'm no play at all. I'm either long or nothing. And that's what MU was the first hour of the day. Okay? So when you look at UNFI, yeah, it was up a lot. Yeah, it looked a bit climactic, right? Big time volume, etc. And then it put in this other top. But notice, even on the one that worked, which only went about 1 R, 1.5 R, it still pivoted and went higher. That's the kind of strength that this had today. So I would encourage you guys to be very careful trying to pick tops on stocks. I know what you're getting. You're like, but Jared, it's never up 22%. I know, but today it is, and it's going higher. All right, so be careful. I consider this lack of knowledge. I find this to be a very aggressive trade. The market was getting utterly, absolutely destroyed yesterday. Destroyed. And this stock's just shooting the moon? You don't want any part of that short. You don't want any piece of that thing short. Let it go. Walk away. Put your FOMO in check. And for those of you that don't have the FOMO, it's lack of knowledge if you want to short something like. Again, I preface this by saying depends on your expectation also. If your expectation was to take an R or a half of an R out of this, maybe you'd get away with it. But this was never going to be a 2 or 3 R trade. It was never going to be that. It was too strong. Way too strong. Okay? I'm just reminding you, this is the shit that happens when your expectations aren't realistic. So at first I said, hey, this is what happens when you bag hold. Now we're going to flip it. This is what happens when you have expectations that aren't based in reality. So one, you can blow up an account bag holding, right? Not taking a stop and just holding stocks overnight that have no business being held. The second part of this is what happens when you come into this business not having any realistic idea of what you're doing. So this is a combination of lack of knowledge. This is a combination of FOMO. This is a combination of bag holding. And this is a combination of thinking this business isn't that hard. In 2 months, how'd you make 15 grand? By doing stupid shit. You just got away with it. You got lucky. What happened? Reversion to the mean. 52,000 into 2,600. Reversion to the mean. When you do enough stupid stuff, it catches up with you always. Not sometimes, always. Every time. If you take nothing from this lecture today, take what I just said. Doing stupid things always catches up with you. Always. It's the rare person that gets lucky, wins a bunch, and walks away from the table. It's the rare person that does that. Most people think that they're actually making money because of skill, and they keep doing it, and then the bottom comes out. Okay? This person didn't realize that 37 into 52 was just pure dumb luck. And then they started losing and losing and losing more and doubling down and tripling down, and then all of a sudden 52 turns into $2,600. That's insane. It's almost a $50,000 loss. This is coming into the business unprepared with unrealistic expectations and thinking it's too easy. It's not a joke. Okay? Doing smart things does catch up with you, right, Hugh? Doing the right thing is always the right thing to do because it's the right thing to do. Every once in a while, yeah, you'll get slapped for doing the right thing, but most of the time, the right thing will pay you out, right? So, another comment. Bad trades. Luke says, this stuff is really effing hard. Really? I didn't know that. Yeah, it is. Come on, man. It's really hard. The intro to this video, I literally said, this will be, outside of being in the military, this will be the hardest thing you've ever done in your entire life. Bar none. Okay? So, here's another example. This was a trade that somebody mentioned a few weeks ago in the chat room. All right, somebody said, hey, Jared, can you take a look at Netflix on a 5-minute 3-bar play for me? Okay, and I like I said, I wish I would have done this a week or two ago because I would have had so many more of these. But Netflix during this time was on a pretty serious run, right? 1, 2, 3, 4, 5, 6 bars up, little minor pullback, and then rip the next day. So a couple comments here. 594 up to like 601, 602. So you have a $7 move here, maybe an $8 move, $7 to $8 move. Okay. Now, Netflix on an average day does about $10 a day. Lately, it's done way more than that. Like lately, it's been doing $20 days, anywhere from $10 to $20 days. Okay. So wide range bar, narrow range bar, and this person wants to get in this. Why? right? Why? To me, this is a FOMO trade, right? To me, this is a FOMO trade. This is, well, Netflix just always goes up forever. Well, it had been going up, right? I mean, it jumped from 520 all the way up to like 620, a little less than that, right? And this is the day that happened. And what happened? It bounced up a little bit higher, and maybe the person got away with this because it did go to like 610 or 615 or something like that. So again, maybe this person got away with it. They put themselves like a $4 or $5 stop loss, and this thing went about 10 bucks and ultimately ended up working. But it still wasn't a good trade. And this is the problem. When you take a bad trade that works, you think it's a good trade. This stock is way extended on the daily. We know this because look what it's done over the last 3 weeks, right? This thing pulled back pretty heavy. Not crazy bad, but it pulled back pretty good. It's been chopping around since then. What's the point here? You just got lucky. You got lucky that you literally got out right at the top. It's just dumb luck. Don't think it's skill. Don't do this. Don't think that 37 into 52 was skill. Don't think this. Don't think this was skill. This was luck. Okay, this is a trade you shouldn't have been taking. Right now, again, maybe as a scalp. And even then, you can see I'm kind of hesitating. I don't even think I would have taken it as a scalp. Already put in a $7, $8 move. $4 or $5 stop loss. You're going to need $10 more. You're going to need a full $20 move after a stock has gone up like 8 days in a row. What? No. But you'll do it anyway. But Jared, at 5 minutes, beautiful. It was a nice 5 minute. The daily stunk. Terrible. You just got lucky. A day later, and you stop out on this. 1 day later, you stop out on that. It's tough, man. It's really, really hard. Okay? So you got to come back and ask yourself, am I doing these things? Do I have money management rules, right, that I'm not following? Do I even have money management rules? Okay? Do I let 1 or 2 bad trading days mess up an entire month? You probably do, right? We talked about it the other day. You might have 15 up days and 5 down days, but 2 of those down days are like minus 4R days and they eat up 8R. And you're only up 10R for the month anyway, so those 2 down days, now you're only up 2 or 3R for the month. You need to stop. And the problem is you'll have that down day and you're like, I'm not doing that again. And there's no way, that's it. This is the last time. A week or 2 later, boom, doing the same thing over again. You're like, I thought I learned. Don't take stop losses. This is an account destructor, a destroyer of accounts. This is the Death Star, not taking stop losses. It's a Death Star. Okay? Bad trades, we can overcome bad trades. A lot of bad trading is either a FOMO or a lack of knowledge. Yes, don't get me wrong, there is discipline involved there, but a lot of bad trades I find from you guys in the chat rooms, you just don't know. Now, some of you are guilty of you do know, and you just don't have the discipline to lay off that pitch. Right? You're swinging at the high heat, high fastball because you can't lay off it. Expectations not based on reality. Anyone who's in this chat room shouldn't have that because every damn day I sit here and hammer you guys over it. So I wouldn't expect anyone that comes to live traders to have expectations not based on reality. If it's your first day, maybe. But after being here a couple days or a week, I would not expect you to have this. So here's the thing. This is the $64,000 question. What are the solutions? How do we fix it? What do we do about it? 1, have a trading plan. All right. There's many of you out there that act like you have a plan, but you have no written plan. You don't. Admit it. You just don't. Okay. These next 2 or 3, I think, are really some of the most important things you can do. Get a trading buddy or an accountability partner. Find one, and find one fast. Okay. It doesn't even have to be somebody that knows about trading. It's nice if they know about trading, right? Because they can empathize with you. But it doesn't have to be. It just has to be somebody that holds you on the straight and narrow. You tell them this is what I was supposed to do, and this is what I did. And they'll go, well, why? And you can sit down and have that conversation. Put together a severe consequence system, okay? Severe, like so bad you can't even think about breaking it. I mean so bad that it repulses you to think about breaking your trading plan. To where it would take 1 time of that consequence system to put you on the straight and narrow. It's got to be bad. It's got to be severe. Otherwise, you're just going to... Remember what I joked earlier? You guys are habitual line steppers? Yeah, you guys always step over the line. You're always pushing the line. Why? That's weird that it did that. Hold on 1 second. That's so strange. Whatever. It is what it is. Right? You guys are habitual line steppers. So make it severe so that you won't ever do it again. Use OBS, right? I think it's Open Broadcast System. It's free. Buy yourself a $20, $50 webcam. Record your trading, right? Go buy a Logitech webcam, right? It's, I don't know, what are they? C922 or C920, 50 to $100. Video yourself trading. Put a mic to it and just be you. Don't worry about the camera. Don't worry about, just be you, okay? And then have your accountability partner take a look at it. And then put your feet to the fire when you mess up, because it's unacceptable. Again, you're going to have to feel some pain. We all do. None of us are perfect. We all have to feel pain. We're like teenagers, right? We think we know everything when we don't. We think our parents are dumb, and then we find out when we're 35 that they were right. You're going to be that way. So I'm expecting you to make some mistakes. The question is, how frequently will you make those mistakes? And it's the traders that get really good at this that don't make the mistakes that often. They'll make some, but they're not going to make the same number of mistakes that the people who fail are, right? Risk $5 or $10 a trade. That's it. Period. I know your ego's like, but Jared, I make $400,000 a year. $5 a trade is nothing. Okay, you're not that good at this. So this isn't your 400K job. This is something new. Okay, it's like, I don't know, playing LeBron James one-on-one. You don't have much of a chance there until you get a little better. So don't waste money. You're just giving away free money. $5, $10 risk. Why? Because if you really mess up and muck it up really bad, it's not going to cost you that much money. Okay. Strict money management rules. Limit the number of trades, the max loss per day, max loss per week, etc. Set small, reasonable goals with a realistic timeline. You have to feel good. If for those of you who watch Dave Ramsey, is like, hey, pay off your lowest debt credit card first, your lowest balance credit card first. Why? Because it's a win for you. Hey, I paid that one off. It makes you feel good, right? You're reforming an entire house. You get one room done. You're like, man, it feels good. Now I get the motivation to move on to the next room. Same with trading. Make them small, realistic goals. So when you hit one, you crush a goal, you're like, sweet, good, I can do this. But if you're always getting hammered and you're not reaching your goals, you're going to feel depressed. You're going to lose confidence, and that's going to be a downward spiral. You don't want to be in that position. Track and review all your trades. This one, I'm borderline speechless here. You know how many traders I meet that don't track their trades? It's pathetic. I want to say 75 to 80% of traders I meet don't track their trades. Yeah, you heard me. It's that high. It's unbelievable, actually. It's filthy disgusting. How are you going to get better? How are you going to get better if you don't track your trades? How are you going to know what you're doing right and what you're doing wrong? I don't know. They literally write down their P&L at the end of the day. That's what I see most traders doing. They just write their P&L down at the end of the day. Wow. You don't belong in this business if you're not even willing to do that, right? So these are some things that you guys can do to be better, to not have FOMO, right? To use better money management, find a trading partner, an accountability partner, have a consequence system, put it in your trading plan. Also, make sure you put those goals in there, little goals. Make yourself feel good from time to time, because this business is hard enough without just hammering yourself every day, getting down on yourself, losing confidence. But despite all of that, you're still going to have to work at it, right? There's not like one thing that anyone can say to you. There's not a holy grail comment out there that will just automatically make you a great trader, right? There's not a holy grail comment out there that would just automatically make you a great trader. You will work at every one of these things, okay? So I hope you learned a little bit about FOMO, bad trades, and failed traders. Understand, please, that it's going to take you some time to correct these issues. But again, setting small, reasonable goals is your first step, and making sure you have somebody to hold you accountable will make sure you don't make those mistakes over and over and over again. It's a lonely business, trading is, right? You're by yourself in front of a monitor, and the only person that knows you messed up is you. Literally, in the entire world, the only person that knows you messed up is you. So give that some thought. You're going to have to bring someone else in so that they can, again, not hold you accountable, but make you feel bad enough that you won't do it again. And you know the line, I say it frequently. You won't change until the pain to stay the same becomes greater than the pain to change. It's the only time you're going to change. Until then, you'll just keep messing up and making excuses. Messing up and making excuses. Why? Because human beings are really good at deflecting blame. They're really good about playing the victim. They're really good about misery loves company. Don't be it. Most of society is that way. Everyone has an excuse for why they're not where they want to be in this world. True? They do. Almost, it's such a rare person that says, hey, you know what? That's all me. It's all me. It's very rare you find that person going, yeah, those are the choices I made that put me in this position, and I deserve to be where I am, for better or worse. Most people, it's, oh, my boss doesn't like me, didn't give me the promotion. Oh, well, I went to a bad school, so I didn't have a chance to begin with. Oh, my parents were broke, so I never had a shot in life. Whatever. Whatever the excuses, people have it. They're filled with them. Don't be that person. Don't be. Be the best that you can be. And I bet you'll surprise yourself how good you can be. All right. I'm Jared Wesley of Live Traders. We'll get back at it again next week.